The Rebel Capitalist Show.
As far as the risk curve and the Fed, just artificial interest rates, dropping them so low or artificially low interest rates, excuse me, and just pushing everyone out to take more and more and more risk, whether it's a pension fund, whether it's a retail investor. We talked about SPACs. And let's go through that, explain it for everyone out there that might not have a good understanding as to what they are, and maybe try to parlay that into showing or maybe giving us an example as to how frothy the markets are right now. And what I'm really trying to go over in my own mind is, are we at peak risk curve? Does that make sense? I mean, can the Fed push the retail investor can they push them to take any more risk than they're already doing without just going to a casino or playing the lottery?
Well, it depends how many $2,000 a month universal basic income or MMT checks people are going to get, because the Fed is maybe hoping that people are going to gamble, open up a Robinhood account and gamble on stocks or buy call options on Tesla or buy crypto. So it really depends on how much monopoly money at this point. In general, George, and SPACs, which are special purpose acquisition companies, are also called blank check companies. I really think this is a symptom, and you've been talking about this, and I've been talking about this for a long time too. And if you talk about this on Wall Street, this will get you fired. The Cantillon Effect.
Right.
So the special purpose acquisition companies are just another example of the Cantillon Effect. And this is where you have the large banks, hedge funds, private equity, large corporations all getting artificially cheap currency and credit. That is either near zero.
The political insiders and the financial insiders.
Yes, and the lobbyists. So really the special purpose acquisition companies, and we were talking about this before we started recording. Paul Ryan, who's a key political insider, former Speaker of the House, Mittens Romney's former vice presidential candidate, he raised $300 million for a special purpose acquisition company in, what was it, February or March, I believe. So there's an insane amount of SPACs. There are some useful companies that are special purpose acquisition companies. There's some electric vehicle charging stations and some others, but the overwhelming majority of these are rich people that have contacts and access to currency and credit, business contacts. Some of them, George, don't even have a business plan. These are shell companies. There are comments out there from Lloyd Blankfein, who I guess is taking a break from doing God's work. And he actually did an interview on CNBC, I think it was in October. It was about 30 minutes long, where he was actually honest about all this currency and credit sloshing around, all the asset price inflation, all the wealth disparity, how the wealth effect hasn't worked, and then talking about how ridiculous all these extra SPACs are. I think there's a SPAC of a SPAC now. There was a new SPAC ETF that just launched. It's getting ridiculous. I think there's about Monday through Friday, there's about 4 new Securities and Exchange filings for potential SPAC IPOs. And a lot of these companies, George, don't have a business plan. They have assets that they bought cheaply. They've been packaged up together. They're coming up with ridiculous names for these SPACs because I guess they're running out of names. So maybe they'll call one like the Enron SPAC or the Bernie Madoff SPAC. And then they'll finally just and maybe that will be the peak risk.
Yeah, and to be clear for the people listening or watching who might not have heard of a SPAC, or you probably heard of it but don't know exactly what it is, the blank check company is a great way to describe it. And it's basically, you have a shell entity that often has no assets, has no business, has nothing. It's zero, except for a guy like Paul Ryan that says, "Oh, trust me, give me your money, and within the next 2 years, I'll find a business to buy, and we'll make a ton of money. We'll give you a great return, and then here's some equity, and here's a warrant or two." And the people just give them their money with no cash flow, with no business plan, with no assets, with nothing, just on a hope and a prayer that this person at the top can find some investment that will make them money or some acquisition target within the next 2 years. But other than that, it's just pixie dust. It's
it's a story stock. So
yeah.
it's what Jim Chanos is saying. The goal is to get in early. So if you're a key insider, you get those warrants, you get in early at a cheap valuation. And it's been this way in Silicon Valley with all these unprofitable companies, revenue growth only companies that have no chance of being profitable. Some of these companies, as they scale up, they lose more and more money. Look at Uber and Lyft and all these other, and not Airbnb, the other WeWork. All the long list of all these Silicon Valley unicorns now. And a unicorn used to be $1 billion company. I mean, there's so many of these things with valuations over $1 billion that have no hope of achieving profits 10, 20 years from now. Buy assets cheap. Buy assets cheap. And as Jim Chanos says, total addressable market. So they create a story saying they're going to go after this enormous market that's tens of billions per year or hundreds of billions total, or at some point it's going to be that way. But the company doesn't have any type of business plan to achieve profits, free cash flow, the normal things at a normal business, how things used to be. But ultimately, the peak risk, what you're talking about, ultimately the goal is for the insiders to get out and dump this stuff onto retail investors before it crashes. And we've seen this with a lot of IPOs the last few years, how Wall Street has brought so many, and Wall Street's collecting enormous fees for this, bringing these unprofitable companies IPO and then lying about the potential of these companies. These companies, after the lockup period expires, whether it's a Tilray, the marijuana company, and at a certain price, if the stock is $1, maybe it's cheaper. But I think Tilray was it was an enormously high stock at one point. And I spent a couple years ago going through their prospectuses and their prospectus, and their SEC filings, annual report, and their other SEC filings. And there was admissions in there by the lawyers and the executives that the company might never be profitable, and the company was losing even more money. So the more the company scaled, the more money it lost. And yet the story was being sold about the total addressable market for legalized marijuana, and the shares crashed. So you're seeing this repeat over and over, and the retail investor is just falling for it, hook, line, and sinker, unfortunately, more often than not.
And it all goes back to the Fed. And the reason I say that, Jason, is just for the average listener out there or viewer, in my opinion, and I'd love to get your feedback on this, if interest rates were still at, let's say, 5%, Fed funds, 5% or 6%, which is, by the way, historic norm, would any of this be happening?
No, I don't think so.
Yeah.
Well, I think the Ponzi scheme, and George, this whole system that we have now, and we're at over 270 trillion debt globally. If you add it up at all levels of society, the majority of the debt's government debt and corporate debt. This is a Ponzi scheme. Right. Okay? Because, and people ask me, why is this a Ponzi scheme? And I love the Kyle Bass quote, "A rolling loan gathers no loss." Now, Kyle says that's for the Chinese banking system and Chinese corporate debt, but now it's for everything.
Yeah, so the entire global economy.
It's the entire global economy. There's an enormous bond bubble. I could give you countless examples of this asset price inflation, distortions with the Cantillon effect, and the bond bubble of these central banks subsidizing big government, subsidizing this bond selling scheme that these large banks have, this bond trading scheme that leverage hedge fund traders and other financial professionals do. And so corporations can sell artificially cheap debt with the help of credit ratings agencies that won't downgrade them. And the reason this is a Ponzi scheme, in my opinion, is because newer and larger amounts of debt is issued to roll over existing amounts of debt that cannot ever be mathematically paid off. So that is the problem. The problem,
or even serviced at a normal interest rate.
Exactly. Well, even at zero, even at 1% or zero, the debt can't be serviced. Look at Japan. Japan cannot even have a 1% rise in interest rates. They're bankrupt if that happens. So the problem is cash flow. All this debt, George, has been used unbelievably unproductively. So if the debt was for infrastructure or new products and services, that would increase cash flow. New products and services for a company, that would increase cash flow. That could be used to service debt, pay off debt, and that is not happening.
Right.
So that is the problem. The problem is you cannot grow debt without cash flow, because normally you're a real estate investor, you know this, and we're friends with, me and you are both good friends with Jason Hartman.
Yeah.
And how real estate investors use cash flow is you take out a mortgage on a rental property and then you use the cash flow and you pay back your mortgage. And then you repeat it like in the game of Monopoly.
Yeah, exactly.